I'd also like to change hats a bit now and become moderator of this panel. And I'd like to bring up Lou Friedman, managing partner at Flexus Capital, and Lamar's chief executive officer, Sean Riley. Gentlemen. Hey, Lou. Morning, Sean. Good to see you. Ben, let me just come back to your survey, if I might. Can you just tell us again, who were the respondents to that survey?
So we survey about 200 small businesses in a range of different revenue sizes, usually about $1 million a year so it's truly a local survey. It's not intended to capture the national mood, although I do think there's probably some decent correlation.
Well, and that's the question. Sean, you were telling me yesterday about what percentage of your total business is local versus national?
77% local.
Okay, and Lou?
Our company, Total Outdoor, is probably 70% national, 30% local.
Perfect. So we've got a yin and a yang here. That's good. So you saw some generally good news in Ben's numbers.
Absolutely. When we look at our book and our pacings in 13 and 2014, you're spot on. Congratulations. The 1.9% GDP, well, you know, we were 1.9% organic last year. The as reported was a little higher because of acquisitions, and your point about capacity is important as well. We throttled back adding digital capacity, and you know, we learned that, okay, we're going to grow at GDP. If we add that digital capacity, we've got a shot at beating GDP. That shows up.
So as you both look at the national market, how do you think, Ben, that your data informs the national perspective, and then we'll come back to you, Lou, to talk about what you see a little differently in the national marketplace?
Well, I think where the local-national relationship is a little bit, where you see different aspects, is really on the economic sensitivity. I mean, the national money's been at a high level, maybe not for outdoor, but at a high level, much more consistent, you know, since the downturn, whereas local tends to swing with economic shifts, things like the fiscal cliff and other things that move more quickly. So we see more volatility, and you see that sort of economic sensitivity in some of the answers. But the bullishness we hear from advertisers on the local side, we've also heard at the national level. You know, it's been disappointing Q1, both personally living in New York with the weather, but as an analyst following the sector, you sort of come into 14 with a lot of momentum, and then all of a sudden, you know, there's no retail activity, there's no one's buying a car, the GM situation hasn't helped.
The Target situation in the fourth
quarter.
Exactly,
yeah. So there's been sort of these weird idiosyncratic issues that have popped up, but I still think the momentum, you know, is there. And, you know, the jobs numbers last week, I think, point us a little bit in the right direction. And I think it sounds like April's off to a decent start. Easter coming on, so I think we feel pretty good.
Good. Lou, you want to?
Well, Jack, our company's obviously a lot smaller than Lamar. We're an independent operator focused just in the top markets and large format outdoor. We started the business in 2011 backing a team led by Randy Swain, former Ackerley Group CEO. And the dynamic that we see is that in our markets, there are some incredibly positive things going on in the sense that the marketplace itself, with the advent of digital where it can come in, and the eyes on or now TAB outdoor ratings has given starting to give a level of confidence that I think, while there may have been some weakness in the first quarter that a lot of people may have seen, the level of activity, the discussion, the planning, and what we see happening through the rest of the year is more consistent with what Ben is talking about.
And when you hear 28% of respondents that their out-of-home budgets are sensitive to the economy, does that number hold in the national marketplace?
What happens on the national side, and Sean obviously sees this as well, just given its footprint, but what happens with national buyers is you'll have shifts. So there'll be moments in time where, as Ben's charts indicated, the auto industry starts moving in a direction which is sort of a forward indicator of where the economy is going, or pulls back. You'll see mobile advertising, for example, propel at a time, or again, pull back. And so some of these shifts are actually shifts between sectors of advertising. interestingly, over the last several years, very consistent and in fact increasing buying by alcohol and other beverages. The entertainment category has held up. So, I think it's very hard just sort of ubiquitously to say, what's national doing?
Yeah, and in our book, it behaves a little differently than you described, because in our book, local does this, and national does this around that line. And looking back to last year, our first half national was very strong, up 5.5%. And we ended up 2, so that kind of shows you what happened to national in the back half of the year. And then as we started this year, we're cycling around to some pretty tough comps on the national side. We think for the first half of this year we'll be up 1 on the national side, and given that we kind of guided to between 2 and 3 for organic growth, I can tell you what's going on with the local book. So, you get a little more oscillation on the national side and a little more steady eddy on the local side, at least for our book.
Yeah, my point on national consistency was at the sort of the overall budget
The overall
level.
pie, the whole ad pie.
But one account who will remain nameless can move things around
and
the
they
outdoor
did.
business quite a bit.
And they did.
Well, I'll tell you, Jack, one of the other things that one of Ben's charts showed, which was the duration of contracts, that's one of the things that really does play a big difference, and we've seen changing between our business and Sean's. On the local side, certainly Ben's chart's very accurate that those durations will go up. In the national side, I think we've seen, in part because of digital's ability to change copy instantaneously, and even for static, to be able to sign a contract on a Friday and have the sign up on Monday, it's turned to more of a spot market, and the contract, there are just fewer perms than there had been several years ago, and so a 6-month contract, looks a lot better, and frankly, a lot of these turn into 3-month type duration.
So there were, when your report came out and I got it and I just consumed it right away. There were 2 points that made me smile. So you had the price expectation by media.
Yeah.
That was huge.
Yeah.
And then you had the length of contract, which for us is huge. Getting over 50%, looking at more than 6 months. For Lamar, that's a big deal. So
Yeah.
that was good
Let's
stuff.
look at that price point and the projected expectation on the part of local advertisers that pricing will go up. I don't think we're feeling that in the national marketplace at all, and more business across the whole advertising landscape, national advertising, is increasingly short-term, with budgets coming in on Friday to start on Monday, and 2 to 3 week contracts, 1-month contracts, as opposed to long-term. So how does that, again, impact the difference in your strategies in your sales organizations and your digital strategies, the shift and difference between national and local?
Well, yeah, part of it is just our footprint and our mix of businesses. But part of it is when we look at our occupancy, we're very close to normalized occupancy. It took us way too long to get there. But I think this is the year where we don't have to sell scared anymore. I think we can ask for it. We can't ask for the moon, but we can ask for modest rate increases because, again, our occupancy is very close to normalized.
It's an interesting word, occupancy, and it leads me directly to the question about programmatic and automated buying, because occupancy in the hotel or the airline business, they've gone to computerized reservation systems in order to manage inventory on a very flexible basis. And pricing accordingly. Do you see the industry, especially as supply increases, moving in that direction?
I think that we are going to have to, for a couple of reasons. Number one, our digital platform lends itself to being able to do that. But number two, as you mentioned, there's 2 buckets of dollars, and we've been going after the traditional ad bucket. There's a digital bucket. And unless we allow them to buy us like they buy other digital platforms, we're not going to get into that bucket. And I don't like to call it programmatic buying because I don't know that we're going to go all the way. But we have to meet them at least halfway.
Automated.
Automated. Oh, that's a better word.
Okay. You agree, Lou?
Well, I think that one of the great things about outdoor, and it sort of is underlying Ben's charts, and frankly a lot of what we all see who are active in the business, is that it's a very unique medium because it is location-based. And so most programmatic buys that you see in television or radio or others are in effect buying a demographic, buying quantitative information to an advertiser across, a national reach. Outdoor, even if Clear Channel and Lamar and CBS pooled their inventory, threw it into, an automated system, it would be close, but it's still not perfect. And so and even if it were all sitting there, what it's missing is what the TAB ratings now include, which is demographic and other socioeconomic information with location. And I think the power of that location can't be missed about the medium, and it is what drives it. So, when I think about the future of the business, yes, there's no question that there will be some inventory that will move in that direction, but I think the real power of achieving some of the things that Ben's projections underscore is how we sit today as an industry with some digital, and remember, my perspective's in the big markets where digital is frankly much more limited because of local regulatory as opposed to the cannibalization or other things that Sean was thinking about in terms of how you carefully think about where to add capacity. The market, in fact, the regulatory market's limiting it. So with digital, with the ratings, we have the ability as an industry to be much more, I'd say, strategic with the ad clients in helping them achieve objectives that we shouldn't be so quick to sort of give up that advantage. And to the question that you were asking before about pricing, I think that precisely because of those two things, the CPMs on outdoor are still so much lower than they are in any of the other things other than Facebook, display. They're so much cheaper that as opposed to being pricing pressure, I think there's actually potential for pricing stability or even increase.
Yeah, I would just say on programmatic, it's going to take a while. We had our tech media and telecom conference in San Francisco about a month ago. Programmatic buying was a big theme, but I think the inventory move to programmatic is going to be slow. You're going to have to rip it out of some people's hands, if at all, to get it. And even within the inventory, let's just say you took a television company or an outdoor company, I think you're going to see a subset of the inventory sold through an automated platform, probably the stuff that, remnant sounds like a bad word, but I think everyone knows what I mean. You'll see the long tail stuff that is unsold go in there first, but your core quality inventory, I'd be shocked if that's being done on a programmatic automated system basis, even within 5 years.
Well, it'd be interesting to hear from some of the agency executives and see what Jill and Jack and I know Marianne Gambelli from Horizon is here to see what they're saying in that same context in terms of the timetable, because I do know that most of the agencies are making it a pretty high priority. And I agree, there is that bifurcation between the premium and the commodity, but where that line is drawn is a really good question. As you look at the Wall Street realities of our business, and Lou, you came into the business because you saw an opportunistic buy into the industry. And that suggests that at the other end of the spectrum, you see the opportunistic sale at some point. And I don't want to put words in your mouth. And I know we can't really talk about any of the issues of CBS and the IPO and their offering because we're still in a quiet period.
I can't. You guys are welcome to.
And we will have, Jeremy Males will be on our CEO panel at the end of the conference that I urge everyone to stay for. But as you look at Wall Street and the realities of a public company and a company with EBITDA goals, and as you look at it from the buy side, how do you balance the incredible need for investment that this industry has had and will continue to have versus your quarterly requirements that Wall Street puts on you, and this perhaps imbalance between the investment and the payout for that investment?
Well, we've always invested where we could get the best return, and that can't happen quarterly. You have to, we invest in real assets that amortize over time. I think today the challenge that we're going to have is as we prepare for this REIT conversion, which Wall Street is very excited about, we have to keep a couple of things in mind. That it's a legal and accounting construct. It doesn't affect the way we do business, the way we sell and service our customers out here. So there should be no change, and certainly no swinging with quarterly guidance when it comes to that. The good news is REIT investors think very long term. They're very patient. So that's a good thing. The other thing about being a REIT, I think that is important for us all to also keep in mind is that we're not going to abandon those non-REIT qualified businesses. You know, we wrap buses, CBS wraps buses. We're going to stay in those businesses. We're just going to operate them in a taxable subsidiary. So, you know, when I think about being public or becoming a REIT and the pressures and should it change your business model, the short and long answer is no, it shouldn't.
Jack, you know, as you know, I started my career on Wall Street. I spent 25 years advising companies, primarily in the media, telecom, consumer sectors. And so when I started Flexus Capital, our private equity business, 5 years ago, what we were looking at were a lot of different sectors to invest. And, you know, early 2009, the television station business was flat. I mean, just frankly, every advertising driven sector. And one of the things that I liked about outdoor that sort of propelled our investment was that it had been able to, as Ben's chart had shown, maintain share relative to online, taking away share from every other form of media. And it's a very simple concept, which was when you're in your car, no matter how much time you spend on mobile or online or whatever else it is, you're behind the wheel, you're not distracted until the Google cars take over, but you're basically visually, the only way an advertiser can reach you is on that sign. And that defensibility, combined with the fact that when we began the investment with, you know, Randy and our partners to create Total Outdoor, we had a window of time that I saw because Sean had told Wall Street that he was not going to be buying things till he got his leverage down. Clear Channel was owned by a couple friends of mine, Bain and Tom Lee, and I knew that they were, you know, needing to service the debt at the broader group out of the outdoor cash flow. And CBS was part of a big media group, and the question of how they'd allocate capital that we thought said to us that remaining 30+% of the independent market gave us an opportunity to come in and invest with the right management team and buy or build, while frankly the big guys were on the sidelines. The investment thesis has been, you know, proven correct. We've made 12 add-on acquisitions. Our team's built over 75 signs, all in sort of the top markets, although we're not, you know, as big in New York and Los Angeles. We're large in Chicago and San Francisco, companies in Seattle, Portland, Detroit, Boston. You know, I think that the point is we've had this window of time. So to your question, now that CBS goes public, it'll get spun off later this year from the parent company and be a pure independent company. What does that mean? My view is that it doesn't mean it's a time to sell the company. It means it's a time now to be much more focused and consolidating what we've been doing because we're at a point where the ad recovery has been frankly tepid. And I see much greater opportunity over the next couple of years. You know, we're all sort of business people. I mean, I think today, if you know, someone came to Sean with a offer that maximized the value for his shareholders, notwithstanding that he's not trying to sell his company, he'd be responsible in looking at that too. We'd be in the same position. So we're not trying to sell the company. We don't have any intention to get out. Frankly, I'd like to grow it enough to give Ben another company to trade and follow, because I think that's really the right path is to have another public currency.
Do we have any questions? I know it's always tough in an audience like this to raise your hand, but I just want to, if there's something that is important to you guys that's being missed. Anyone? We have mics in the audience. Francois, of course. I was depending on you, Francois. Come on.
It wouldn't be a conference without Francois' question.
Ben, this is directed to you as you're looking from Wall Street. There's also a migration that's happening with sites out of motion. The $75 billion that's spent on television now that's been digitized, that's going online to a large extent. But there's also the phenomenon of digital place-based. Cinema comes to mind that's in the audience here, and all the other players have got screens that could be in airports. All the majors are in airports and malls, and now running TV spots, some with sound, some without, and also the migration of online that's going to digital place-based. Can you comment a bit about that phenomenon?
Yeah, thanks for the question. We did an analysis this year looking at sort of redefining TV and online video as just video. And one of the things my colleagues who cover Facebook and Twitter and Google and the internet space, we sort of looked at their advertising expectations and our advertising expectations and said, okay, can this actually happen? Are we adding up to some ridiculous ad total that can't be met? And what we found is we need better economic growth for the estimates to be achievable. And I think some of the pullback in the market you've seen on the internet stocks has started to, you've seen some of this stuff, some of the froth being shaken out a bit, but we need a better economic growth outlook. And then you also have to believe that video is a share gainer going forward the way it has been in the past. And when you define video broadly to include the internet, I think we're now 28% of ad spend in the US is quote unquote video. It's adding share every single year. And so if you believe that's going to continue, then I think there's an opportunity for lots of companies to benefit from the move to sight, sound, and motion. Because I agree with you, you can see it in the CPMs. That's where the demand is. That's where the value is placed. And so it's an opportunity for everyone in the out-of-home space to take advantage of moving forward.
Lou, final thoughts.
Yeah, Jack, I'll tell you, this is one of the biggest themes that I think we face as an industry. The world is moving in a way, as the question asked and Ben's response, to be completely focused on online because of its seemingly greater ability to deliver audience and actionability. The Interactive Advertising Bureau, the IAB, the Trade Association for Online, estimates that 36% of online traffic is fake. Okay, so what happens is that the number of viewers and what they're actually doing, we have an internet billionaire who's one of our investors, and this guy was, as he made the investment in Total Outdoor, he said, I drive down the highway, I see this gigantic sign. I have no idea whether anybody's ever seen those display ads or anything else like that. The fact is, it's a medium that works, and now that we have a rating system that we can put quantification and sell, hopefully as part of a media upfront plan as opposed to a below-the-line cost, I think the opportunity is unbelievably dynamic for the industry so long as the outdoor sign companies work closely with our partners in the advertising agency world, both with the specialists and the planners, to create and capture that opportunity.
And you mentioned 36% in video, according to a report released by Distillery. 50% of online video traffic is fraud, so it's a real issue. Sean, final thoughts.
Well, I mean, to that point of what's real and what's not real, certainly the market caps of those internet companies that spiked, there was not enough ad dollar or ad spend ever to equal where that was going. However, when you look at our opportunity, our opportunity to grow is to complement what they're doing. I mean, if we can do a better job of, and I hope to talk about this on Tuesday with you, if we can do a better job of as an industry of complementing mobile, of geofencing and targeting our units, demonstrating, and we have in several tests that I'll go into on Tuesday, demonstrating that we can increase click-through rates by combining out-of-home with mobile. Our share is going to grow.
I agree. Ben, Lou, Sean, I'll see you tomorrow afternoon again on this stage. Thank you very much. Really good panel. Appreciate it.